In the 1970s and 80s, the U.S. experienced high inflation. The Federal Reserve began raising interest rates aggressively in order to cool off the economy. As interest rates rose, banks and savings and loans institutions found themselves exposed to interest rate risk. Many of them were heavily invested in long-term fixed-rate mortgages or long-term assets like U.S. Treasuries that were offering lower interest rates than assets readily available on the market for purchase. Additionally, the cost of acquiring new depositors outpaced the return they were making off of these assets, which is a bad spot to be. Ultimately, many of them found themselves facing massive losses due to these high interest rate changes and the exposure to risk that brought upon them. Many of these institutions failed during the mid-80s to mid-90s, and as a result, it was dubbed the savings and loan crisis. 30 years later, from the tail end of that disaster, we find ourselves in a similar situation. The U.S. economy has been facing high inflation rates for about 2 years now, and the Federal Reserve has been aggressively raising interest rates. In early March, we saw the collapse of Silicon Valley Bank and Signature Bank here in the United States. During the episode where those two banks failed, there was cause for concern around First Republic Bank, which saw a large outflow in depositors. Ultimately, during that time in March, they were saved by several banks infusing them with some cash, about $30 billion. But since it has come to play about a month later, towards the end of April, First Republic Bank has gone under FDIC receivership after they announced last week of over $100 billion in outflows in the first quarter of 2023. First Republic's collapse is the second largest in U.S. history, and since they have gone under FDIC receivership, a deal has been made with JP Morgan Chase to buy them for $10.6 billion. The collapse of these banks can't help but feel like deja vu as casualties in yet another war against inflation, as the Fed has been rapidly raising their interest rates, and that has let a lot of these banks be exposed to these interest rate risks as their sort of long-term illiquid assets, which are yielding low interest rates, are now becoming worth way less as sort of higher interest rate assets are becoming available in the marketplace. And of course, the cost of acquiring depositors and maintaining depositors is going up as interest rates go up. If you're a fan of repeating history lessons, consider giving a like to this video and subscribing to the channel. Wall Street has been hammering these regional banks this past week and into May as they are growing concerned around these sort of smaller regional banks. Their stock prices have taken a hit, but that doesn't necessarily mean they are in trouble, at least not yet. The way I see it, I think there are really three main risk factors here that could cause a problem for the banking industry. First, we have the raising of interest rates yet again. This last week, the Federal Reserve raised the federal funds rate by another 25 basis points. All signs indicate to them putting a pause after this last increase, but they have risen it significantly over the last 2 years, and the damage might already be done. The second biggest risk is poor management at these different banks. The concern is that many could be exposed to these illiquid assets that have these lower interest rates prior to when the Fed started to increase them in 2022, and now they are worth way less due to that interest rate risk change, and they could be faced with a situation where they are worth less than the cost to depositors, meaning that they're incurring losses and essentially their expenses have become higher than their revenue. The third and final main risk to these banks right now is essentially public perception and depositor fear. If you have a situation where the public perceives that you are in trouble or weak, you could induce your depositors to pull their money. And as they start to pull their money, then you have to start to sell these illiquid assets off at a loss. And that spirals as more people pull their money, like we saw with Silicon Valley Bank back in March. Let me know in the comments below if you think the regional banks are going to continue to see trouble and turmoil, or if you think they are sort of out of the woods, at least for the time being. If you want a refresher on the Silicon Valley Bank situation and how they collapsed, click on the video on the screen now, and that will take you to my recap there. Thanks for watching.